As of the most recent market close, Rezolve AI, trading under the ticker symbol RZLV, is sitting at exactly $3 per share. If you are looking at the after-hours data, you might see a slight tick upward to roughly $3.05, representing a modest nudge of roughly 1.6%, but the psychological battleground is firmly planted at that $3 mark. On the surface, this looks like a stock that has taken a beating, down over 38% in the last month alone. The expectation here is simple, and frankly, it is what the bears want you to believe, that this is just another de-SPAC tech play that fizzled out, a company burning cash with a stock price destined to grind lower into penny stock obscurity. That is the expectation. The reality, however, is far more aggressive and suggests a massive disconnect between the retail panic selling we have seen over the last few weeks and the quiet, methodical accumulation happening behind the scenes by some of the largest financial institutions in the world. While retail traders are getting shaken out by the volatility, smart money is stepping in, and that divergence creates a tension that we need to examine right now. When you look at a chart that has dropped nearly 40% in a month, the natural human instinct is to run. It triggers that flight response. You assume something is fundamentally broken. But if you look at the order flow and the institutional filings from the last quarter, a completely different story emerges. We are seeing heavy hitters like Citadel Advisors and Alyeska Investment Group loading up on shares. Alyeska recently disclosed a position of over 24 million shares. You do not take a position that size in a company you believe is heading for bankruptcy. You take that position when you believe the market has fundamentally mispriced the asset. This is the classic tension between price and value. The price tells you the sky is falling. The value, backed by a discounted cash flow analysis that pegs the intrinsic value closer to $8 or $9, suggests the market is offering a 60 to 70% discount. That is the curiosity loop we are in today. Why is the price disconnected from the analyst targets, which average around $10, implying a potential upside of over 200%? Let's break down the recent price action, because it has been violent. The stock has been oscillating in a range, finding a floor around $2.80 to $3. This level is critical. If you're a technical trader, you know that when a stock hammers a support level repeatedly and refuses to break significantly below it, it often signals a bottoming process. We saw the stock hit an all-time low of $1.07 earlier in the year, only to rocket up to over $14 in August. That kind of volatility is not for the faint of heart. It makes the daily swings in Tesla stock look like a calm walk in the park. What we're seeing now is the hangover from that massive run-up, compounded by a broader rotation out of high-growth, high-risk assets as the market tries to figure out what the Federal Reserve is going to do next. But unlike the massive liquid markets you see for Apple stock or Nvidia stock, where billions of shares trade hands and absorb shocks, Rezolve AI is a smaller float, higher beta play. This means when selling pressure hits, it hits hard. But when buying pressure returns, the moves are explosive. The volume recently has been telling. We are seeing days with 7 to 14 million shares traded. For a company of this size, that is significant turnover. It implies that the shareholder base is rotating. The weak hands, the folks who bought at the top in August hoping for a quick flip, are capitulating. They're selling at a loss just to get out. And who is on the other side of that trade? It's likely the institutional accumulation we mentioned earlier. This is the classic transfer of wealth from the impatient to the patient. It's the same dynamic you see with Schwab Intelligent Portfolios, or any intelligent portfolio strategy where the algorithm automatically rebalances to buy low when everyone else is panic selling. The difference here is that it's active managers making the call, betting that the brain power engine and the agentic commerce narrative are not just buzzwords, but the future of how we buy things online. Now, I want you to pause for a second and really think about your own portfolio. Comment below how many shares of RLZV you currently hold, or if you are waiting for a specific entry price. Are you watching that $2.80 level, or are you waiting for a breakout above $4.75? Let me know in the comments because the sentiment on this stock is incredibly polarized right now. Let's talk about the business itself, because this is where the reality part of our equation gets interesting. Rezolve AI isn't just building another chatbot. We have seen enough of those. The term they're pushing is Agentic Commerce. Now, in the world of online investing and investment help, we are used to seeing companies throw around AI terms to pump their stock. But Agentic Commerce refers to AI agents that can actually execute tasks, not just retrieve information. Imagine an AI that doesn't just tell you where to buy a jacket, but actually negotiates the price, selects the size based on your history, and completes the checkout for you. That is the vision. They're moving from conversational commerce, which is just talking, to agentic commerce, which is doing. They have been hiring aggressively, poaching talent from Microsoft, Google, and Apple. You do not leave a comfortable, high-paying job at a trillion-dollar tech giant to join a small-cap firm unless you see a technological edge that the market is missing. However, we have to address the elephant in the room, the financials. This is where the risk lies, and it is substantial. Rezolve AI is burning cash. The most recent reports show negative free cash flow. They're investing heavily in growth, sales, and technology, and that costs money. In the current macroeconomic environment, where the cost of capital is high, cash burn is a red flag. This is why the stock is trading at $3 and not $15. The market is punishing them for their lack of profitability today, ignoring the potential profitability tomorrow. This is a common theme if you use investing sites or look at individual brokerage reports. The market hates uncertainty. When you log into your Fidelity account or check your Fidelity Investments dashboard, you are often steered towards safe, cash flow positive companies. Fidelity mutual funds and Fidelity ETFs rarely take massive flyers on companies burning cash at this rate unless they are hedged. But that's also where the opportunity is. If Rezolve AI can prove that their unit economics work, that for every dollar they spend on sales, they get $3 back in long-term value, the stock re-rates instantly. The acquisitive of Smartpay is another piece of this puzzle. By integrating payment infrastructure, they're trying to control the entire stack. It's not just about finding the product, it's about the transaction. This is a page out of the SoFi playbook. Think about how SoFi Invest and SoFi Investing started with student loans, and then vertically integrated into SoFi stocks, SoFi ETFs, and a full SoFi trading platform. By owning the ecosystem, you capture more margin. Rezolve is trying to do the same for mobile commerce. They want to be the infrastructure layer that retailers plug into. If they pull this off, the current revenue figures, which are growing but still small compared to the giants, will look like rounding errors in 5 years. But if is the most expensive word in investing. We also need to consider the short interest. There has been chatter on trading forums about shorts holding it down. When you look at the data, the availability of shares to borrow has fluctuated, and we have seen days where short volume spikes. This creates the potential for a squeeze. If the stock pushes past that $4.50 or $4.75 resistance level, the shorts who are betting on bankruptcy or a return to $1.00 will be forced to cover. That buying pressure, combined with the institutional floor, could cause a violent move upward. This is the mechanic that fueled the Robinhood craze a few years ago. Traders on the Robinhood app, utilizing Robinhood stock trading and Robinhood fractional shares, love these setups. They look for high short interest, a low float, and a catalyst. Rezolve checks all those boxes. But unlike a meme stock that has no underlying business, Rezolve has a roster of partnerships with major retailers and tech giants that validates their technology. The macro environment is also shifting. We are entering a period where the Federal Reserve is balancing inflation with a cooling labor market. If rates come down in 2025, small-cap growth stocks like Rezolve are the first to benefit. Lower rates mean cheaper capital, which extends their runway and lowers the discount rate analysts use to value their future cash flows. This is why you see such high price targets. When you adjust the models for a lower interest rate environment, the present value of that future cash skyrockets. This is something you can track if you use interactive brokers. The interactive brokers trading tools and